Hello, greetings from Kotak Mahindra Mutual Fund. We would love to analyze budget and market outlook for you. The Finance Minister has presented a budget which is more for a test match rather than T20 match. It is less hype and more substance. It essentially does few things which are unique in Indian context. One, it is giving more resources to the state. The states will now decide where they want to spend the money, and hopefully they will spend it more productively than the central government. Second, the fiscal consolidation message continues in the budget. While the fiscal deficit number has come down to 3.9% from 4.1%, market may feel that it is little higher than 3.6%, which was promised last time. But one needs to see that this year, central government has increased allocation to state government by more than 1.8 lakh crore, which is 55% jump. So while the central government's fiscal deficit will be higher, the state government's fiscal deficit could be lower. The other thing which government has done is that they are spending money on infrastructure. The total expenditure is up 5%, but the capital expenditure is up 25%. This year, the government will be spending $39 billion towards capital expenditure. It's the highest ever jump in the recent time. This budget is for the long-term development of market. The government has introduced gold bond scheme and gold lending scheme. If Indians stop importing gold, then we will be saving roughly about $50 to $55 billion a year. That is more than what we receive in FDI and FII. We hope and pray that government will construct gold bond scheme in a manner which will be acceptable to the investors. The government is launching National Investment and Infrastructure Fund. They will contribute some money, and then NIIF will go and leverage it. And thereafter, they will give this money as equity contribution to various infrastructure companies and projects so that they can further leverage it. This multiple leveraging will ensure that there is more capital available for the infrastructure sector. The focus of the government spending is on the railway and roads. Hopefully, this 40,000 crore extra allocation to road sector will have multiple resonance in the economy. Net-net, we believe budget is very good. It has maintained the path of fiscal consolidation. It has increased capital spending, especially on infrastructure. It has given something to the consumer. It has given something to the manufacturer. And a combination of this will ensure that the markets will remain supported. If you look at the debt market, they will be especially encouraged by this budget. The net borrowing program is 4,56,000 crore. This is despite fiscal deficit going up in absolute number. The revenue deficit has come at 2.8%, which is exactly in line with expectations. The government is also planning to enter into a memorandum of understanding with RBI, which will give express authority to RBI to target inflation. They are also going to create a separate public debt office. These are all the steps which will take India at par with developed nations. Our feeling is that the interest rates will be on the softer side. The RBI will watch for the inflation trajectory and then take a call on interest rate cut. Maybe they will move a bit slower than what is expected by the market, but nevertheless, we do expect interest rates to remain soft over next 12 months. How should you treat this budget for your fixed income investment? We recommend you to consider buying duration, Kotak Bond Fund, Kotak Gilt Fund. This will be ideal funds for playing duration and getting carry as well as capital appreciation. If you don't want to play duration, then we'll recommend you to invest in Kotak Income Opportunities Fund or Kotak Medium Term Plan, both of which are credit accrual fund, and has limited duration impact. If you are looking to park your money for the short term, do consider ultra short term funds or even Kotak arbitrage fund, which gives better post-tax return. On the equity side, we believe market has reasonably withstood disappointment on third quarter FY15 earnings. The results have been very poor, but despite that, markets have held on to the prices. The market is expecting earnings acceleration in FY16 as well as FY17. The market is expecting earnings acceleration because the capacity utilization will go up. The commodity prices which have come down will result into better margin. Interest rates will come down over next 12 months and which will be reflected in FY17 earnings. So the market is hoping that in FY16 over FY15, earnings will grow between 12 to 15%, and FY17 over FY16, probably it will grow at 20% plus. This creates the base for floor in the market. The other advantage which India today is enjoying is that some of our peers are scoring self-goals. So foreign investors don't want to invest in Russia because of the commodity price collapse. They are wary of China because they have growth slowdown, even though the credit pickup is very, very high. Brazil is officially in recession. So compared to all other peers, India looks brighter, which is growing fast and which has a much stable macroeconomics. So this TINA factor among peers and the accelerated earnings growth which market is hoping to achieve in FY16 and FY17 provides base for the market to go up. Certainly FY16 returns will be moderate compared to FY15 returns. Mid 2013 onwards, market got re-rated from 12 times forward earnings to current level of about 16.5 times forward earning. Clearly, we don't expect markets to get re-rated. The earnings growth will now deliver return in equity market. This time, the game will be more stock specific than sector specific. Today, large cap and mid cap stocks are trading at same valuation, and hence we believe large cap will outperform mid cap. In this kind of environment, we'll recommend you to consider Kotak Select Focus Fund, which is a multi-cap fund, or Kotak 50, which is a large cap fund. If you want to invest in a mid-cap fund like Kotak Emerging Equities, our recommendation will be to invest on a systematic investment plan. This will allow you to enter into mid-cap space by averaging your entry. We'll also recommend looking at Kotak Infrastructure Fund, which is pure infrastructure play, and with the budget's impetus and focus on infrastructure, will be appropriately placed to capture the upside. How should you do your allocation? Depending upon your risk-return profile, you can divide your allocation between debt and equity. We believe this is best time to invest for duration in debt funds and multi-year bull run in equity funds. Will the markets be moving in a spoon direction? Obviously no. There will be event risks and which can create some volatility in the market. We need to be careful about certain event risks over next 12 months. When US raises Fed rate, there could be some outflow from our debt as well as equity market. If Greece decides to exit EU, there will be consequences in our equity and debt market. If earnings disappoint on a quarterly basis, there could be some correction in our market. If commodity prices spike up, then there could be some correction in our market. But all these corrections will provide a great opportunity to participate in the multi-year bull run in equity market. Our recommendation will be to use all this correction as an attractive investment opportunity and invest in large cap funds. We look forward to working with you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.